All right, I've got a story for you today that, honestly, it sounds like something out of a sci-fi movie. But here's the kicker. Every single penny is verifiable on the blockchain. So let's get right into it. How on earth did an AI bot turn a few $100 into millions in just 4 months?
So, picture this. It's December 2023, and it all kicks off with an amount so small you'd literally just scroll past it. $313. That's it, deposited into a fresh crypto wallet.
Fast forward just 4 months. That same wallet, it's now holding over $2.38 million. I mean, do the math. That's a return of over 7,900 times the initial money. It's just a staggering, almost unbelievable number.
And get this, this wasn't some 1 in a million lucky shot. No way. This bot executed over 26,000 trades, and it kept up a win rate of 98%. So the key takeaway here, this wasn't luck, this was a system.
So that's the big question, right? The central mystery we're going to unravel today. How did a piece of software, this Claude AI bot, pull off one of the most profitable and, importantly, most documented trading runs we've ever seen in crypto?
All right, let's start digging in. When this story first hit the scene, everyone's first reaction was, yeah, right, no way, pure disbelief. But here's what made it different from all those other get-rich-quick schemes. This one came with receipts. And I mean receipts that anyone, including you, could go and check. And that right there is exactly why this thing blew up. The wallet address, 0x8DXD, its entire history is out there in the open. Every single trade, every win, every loss, it's all permanently recorded on the blockchain for the whole world to see. This wasn't some magic trick. There was no smoke and mirrors.
Just look at the timeline. It shows you how incredibly fast this all went down. It goes live in December 2023, totally under the radar. By early January 2024, boom, it's already at nearly $500,000, and that's when Finbold breaks the story. Then in March, a public experiment pretty much confirms the AI's advantage, and by April, it's already sailed past the $2 million mark. Insane.
So you've got to be asking, how is this even possible? Well, the bot wasn't just randomly trading. It was operating in a very, very specific environment, and it was exploiting a unique flaw in the system. Let's break down exactly where this money was coming from. Okay, so the stage for all of this was Polymarket, which is the biggest prediction market in the world. Now, if you're not familiar, it's basically a platform where people can trade on the outcomes of real-world events. You know, anything from elections to, and this is the important part for our story, the short-term price of crypto. And the way it works is actually pretty simple. Let's say the market thinks there's a 70% chance of something happening. Well, the yes share for that outcome will trade at about 70 cents. If you buy it and you're right, that share becomes worth a full dollar. If you're wrong, it goes to zero. It's a super direct way to trade on what you think you know. And here it is. This is the secret sauce. Because Polymarket is a decentralized platform, it has this tiny little delay. So its prices for contracts like, will Bitcoin be higher in the next 5 minutes? They update just a fraction of a second slower than the real-time price moves on huge exchanges like Binance. And that tiny delay, that's the entire foundation for this whole strategy. Now, to be clear, this little delay isn't a bug. It's just part of how the market is built. But for a high-speed bot, it's a massive, gaping window of opportunity. See, this strategy isn't about predicting the future. It's about reacting to the present faster than literally everyone else. And what's really fascinating is how this has changed over time. That lag, it used to be over 12 seconds long. Now, as more people and bots have jumped in, it's been squeezed down to just under 3 seconds. But here's the thing. For a computer program that thinks in milliseconds, 2.7 seconds, that's an absolute eternity. It's more than enough time to swoop in and make a nearly guaranteed winning trade. So let me walk you through how a single trade works, step by step. Okay, a new Bitcoin market opens on Polymarket. The odds start at 50-50. Then, all of a sudden, the price of Bitcoin makes a sharp move on Binance. The bot sees this happen instantly. It knows the true odds on Polymarket should probably be more like 80-20 now, but for a couple of seconds, they're still stuck at 50-50. So the bot jumps in and buys the yes side at that stale, incorrect price. 2 or 3 seconds later, Polymarket's price finally updates, it corrects itself, and bam, the bot has an instant locked-in profit. Now just imagine doing that hundreds of times a day. Now, while this famous 0xCT wallet was all about that speed advantage, that latency arbitrage, it's actually not the only game in town. The whole ecosystem of AI bots on Polymarket is pretty diverse. They use a few different key strategies.
So you can see here, latency arbitrage, the one we've been talking about, has that insane win rate. But there are other ways to play it. You've got Oracle arbitrage, which takes advantage of delays in the official data feeds that settle the markets. Then there's news-driven trading, which is pretty wild. It's an AI that's constantly scanning news headlines and social media, placing trades nanoseconds after some big news breaks, long before any human could even process it. Each one of these strategies is just designed to exploit a different kind of market delay or inefficiency, and each comes with its own set of risks.
Okay, so the natural next question on your mind is probably, hey, can I do this? And look, the information is out there on how to get started, but it comes with some huge, flashing warning signs. Let me be really clear. This is not a risk-free game by any stretch of the imagination. So the process starts with the basics, right? Setting up a wallet, getting your API keys. But the most critical steps, and I cannot stress this enough, are steps 4 and 5. You have to test your bot in paper mode first. That's a simulation where no real money is at stake, just to prove your code actually works. Then, and only then, do you set up super strict risk management. We're talking automatic loss limits, a kill switch. These things are non-negotiable. Seriously, skipping these safety checks is just a guaranteed way to lose all your money.
And this quote really just says it all. A bug in your risk management is more dangerous than a losing strategy. Think about that. You could have a brilliant winning strategy, but if there's one tiny flaw in its safety net, you can get wiped out in the blink of an eye. The most dangerous part of your code isn't the trading logic. It's the part that's supposed to save you when things go wrong.
It's also super important to get this in your head. This is not some magic money printer that's going to run forever. That 2.7-second window we talked about, it's getting smaller every day. As more and more bots jump in to compete, that edge disappears. You have to treat this like a business that has a limited shelf life, not some kind of permanent passive income stream. So let's zoom out for a second. What does all this really tell us about the matchup between human traders and these new AI systems? Well, when you look at the data, the verdict is pretty clear-cut. Look, as humans, we're just flawed traders. We're slow, we get emotional and make our bets too big or too small based on gut feelings, not math. We get tired. We panic when we start losing. A bot, it has none of those problems. It executes in milliseconds. It uses perfect mathematical position sizing every single time. It runs 24/7 and never gets tired. And it follows its own risk rules to the letter, no questions asked.
And this chart just paints the perfect picture. In a head-to-head comparison, bots running this exact strategy more than doubled the profits of human traders who were trying to do the same thing. The advantage isn't about being smarter, it's about perfect, cold, relentless execution. And that brings us to the big final question, the thought I want to leave you with. This whole incredible story of wallet 0xDD, it happened because of a tiny 2.7-second delay in one specific niche market. But what happens when you start to realize that every market, whether it's stocks, commodities, even real estate, they all have some kind of information lag? If AI can learn to exploit these tiny little gaps at a massive scale, what does that really mean for the entire future of finance?